Today we'll talk about how to manage balance and track assets. This is where we'll start to use the capital category type. As an example, we'll consider a car. For this property, we'll create a new capital category, which we'll give the appropriate name. In this case, the capital means capital expenditures. Now our car is visible in the balance. And we need to set its value. To do this, we'll create a new operation. Please note that the money was transferred from the cash. Now our balance sheet reads like this. We earned 15,000, bought a car for 10, and we can still spend 5. Let's see what happens on the analysis page. It looks like almost all the money earned this year has been spent. However, this calculation does include capital costs for the car. To exclude them from the analysis, we will use the upper filter. Now we see the report without capitalization. Now that we have figured out how to add an asset, we can consider an example to exclude it. Imagine that we sold the car at a price higher than we paid for it. This operation will look as follows. The amount must be negative. Now the car is classified as a fund, which makes sense since now this category is a source of funding. To aggregate the capital category in earnings, you need to deactivate it. Now it is not visible in balance. If we look at the analysis page, then we find that this profit from the sale of a car does not get into the report before capitalization. It becomes visible only when capital expenditures are added. To separate this profit from capital expenditures, we must take it into account in somewhere else. To do this, we'll update the sales operation and take the profit into account in the BEG balance category. Our balance has not changed. However, in the report we see the profit, regardless of capitalization, because it is taken into account in the revenue category.